In the bond market, there's this simple rule that pretty much everyone knows. But hiding just beneath the surface is this really powerful concept that can give investors a serious edge, and it's called convexity. So, let's break it down.
Yeah, you've probably heard this one a million times. It's like the first thing you learn in fixed income investing. A really simple, intuitive idea that kind of governs how most people think about bonds.
It's that classic seesaw, right? When interest rates go up, the prices of existing bonds go down. And when rates fall, bond prices rise. It's this perfect, simple, inverse relationship.
But what if that simple straight-line seesaw model has a bit of a flaw? A blind spot that really only shows up when interest rates start making big moves. Well, that's exactly what we're here to dig into.
Because in the real world of bond pricing, things aren't always a straight line. They're actually a curve. And getting your head around that curve is the absolute key to truly understanding interest rate risk.
All right, so to get to that curve, we first have to talk about our main tool for measuring risk, and that's duration. Just think of it as our first approximation, our ruler for figuring out how sensitive a bond is.
Put simply, duration tells you about how much a bond's price will drop in percentage terms for a 1% rise in interest rates. So, if a bond has a duration of, say, 7 years, you can expect it to lose about 7% of its value if rates were to jump up by 1%. It's our go-to baseline measure for interest rate risk.
Now, to really get this, let's build out an analogy. I want you to imagine the entire life of a bond, from right now, today, all the way to its maturity date, just laid out as a long, physical plank of wood.
Okay, you got the plank? Now, every single payment you're scheduled to get, every little coupon payment and that big principal repayment at the end is a weight. And you place each of those weights on the plank at the exact point in time you're supposed to get the cash. The small coupon payments are like small weights, and that huge principal payment at the very end, well, that's a really heavy weight. So what's the one single point on that plank where the whole thing would perfectly balance? That, my friends, is its Macaulay duration. It's the weighted average time it takes to receive all your money. It's the bond's true time center.
And this shows perfectly how different bonds can balance in totally different ways. Let's take a 10-year zero-coupon bond. It only has one payment, right? One giant weight right at the 10-year mark. So its balance point, its duration, is exactly 10 years. But now, think about a 10-year bond that pays out high coupons. It's got all these smaller weights spread out along the plank. Those earlier payments literally pull the balance point closer to you, giving it a much shorter duration, maybe something like 7.8 years.
So, duration is a fantastic tool, it really is. But it has one major limitation, what I like to call the straight line problem.
See, whenever we use duration to estimate how a bond's price is going to change, we're assuming that the relationship is perfectly linear. A 1% rate change causes X% of price change, so a 2% change must cause double that, 2X. It's a straight line forecast. But here's the catch. The true relationship between a bond's price and its yield isn't a straight line. Not at all. It's a curve. Now, for tiny little changes in interest rates, yeah, the straight line is a pretty good guess. But the further rates move from where they started, the more that straight line prediction starts to drift away from the actual, curved reality of the bond's price. And, this quote from our source material just hits the nail on the head. The very thing that duration ignores, that curvature, is exactly what determines how accurate it is. And this gap, this growing space between the straight line guess and the curved reality, is where our next big idea comes into play.
So how do we fix duration's straight line problem? Well, we introduce a second tool, a curve corrector, if you will, and that's known as convexity. So if duration measures the slope of that price yield line, convexity measures the curvature of that line. It doesn't just tell us the direction of the change, it tells us how quickly that change is accelerating. Basically, it tells us exactly how bendy the line really is.
So here's the really crucial part. It's about how these two work together as a team. To get a much more accurate estimate of a price change, you start with duration's quick and dirty straight line prediction. Then you add this little correction on top based on the bond's convexity. And that convexity adjustment, that's what accounts for the curvature and pulls your estimate way closer to the true price.
Okay, so this isn't just some academic exercise. Understanding convexity gives an investor a really distinct and, frankly, powerful advantage in the market.
Well, because convexity isn't just a simple correction factor, it's a super desirable feature for a bond to have.
If you have two bonds that look almost identical on the surface, convexity is the tiebreaker that can make a huge difference in your returns.
And this is where the magic happens. Check out this powerful asymmetry. Let's say you have two bonds with the exact same duration. The one with higher convexity is always going to have an edge. When interest rates fall, its price goes up by more. And when interest rates rise, its price falls by less. It literally wins on the upside and is better protected on the downside. It's an incredible feature.
So that's the payoff, right there. Positive convexity is almost like having a financial airbag for your portfolio. It softens the blow from rising rates, and it magnifies your gains when rates are falling. So in a really volatile market with big interest rate swings, an investor who's holding a portfolio of high convexity bonds is going to consistently outperform someone who only paid attention to duration.
And that's really the question I want to leave you with. Is your portfolio built for a straight line, or is it actually ready for the curves? Because honestly, relying on duration alone is like using a straight line map to navigate a winding road. In the bond market, it's the curves that define the journey, and convexity is your guide to navigating them. Thanks for tuning in.